When it comes to understanding a business, few financial statements are more important than the balance sheet. It offers critical insight into a company's financial health. It can be used by investors when deciding whether to provide funding, executives when crafting strategy, and employees when working toward organizational goals. The balance sheet is often organized according to the accounting equation assets equals liabilities plus owner's equity. While this is the most common formula, you may encounter variations of it. No matter how the balance sheet is organized, it should always balance. Assets should always equal liabilities plus owner's equity. Owner's equity should always equal assets minus liabilities. Liabilities should always equal assets minus owner's equity. If it doesn't balance, it was likely prepared incorrectly. Here's a closer look at the balance sheet's key components. An asset is anything a company owns that holds inherent quantifiable value. Assets are typically tallied as positives and broken down into current and non-current assets. Current assets are anything a company expects to be converted into cash within a year, such as inventory, accounts receivable, and cash equivalents. Non-current assets include long-term investments not expected to be converted into cash in the short term, such as patents, goodwill, and buildings and land. A liability is the opposite of an asset. While an asset is something a company owns, a liability is something it owes. Liabilities are financial and legal obligations to pay a debtor, which is why they're typically tallied as negatives. Like assets, liabilities are categorized as current or non-current. Current liabilities are due to a debtor within 1 year, including payroll expenses, rent and utility payments, and accounts payable. Non-current liabilities are longer-term obligations, including provisions for pensions, leases, and deferred tax liabilities. Lastly, owner's equity, also known as shareholders' equity, is anything belonging to the owners of a business after liabilities are accounted for. If you add up all the resources a business owns, its assets, and subtract all third-party claims, its liabilities, the residual leftover is owner's equity. Owner's equity includes two key elements. The first is money, which is contributed to a business as an investment in exchange for a degree of ownership, typically represented by shares. The second is earnings a company generates over time and retains. To see these components in context, here's a balance sheet for a fictional company. It tells you the reporting period ended on November 30, 2020, and compares against a similar reporting period from the previous year. It also tells you the company's assets totaled $60,173, including $37,232 in current assets and $22,941 in non-current assets. The company's liabilities totaled $16,338, including $14,010 in current liabilities and $2,328 in non-current liabilities. It retained $45,528 in earnings during the reporting period, slightly more than it did a year prior. So how can business professionals use this information? Well, the balance sheet serves different purposes depending on who reviews it. When reviewed internally, it gives insight into whether a company is succeeding or failing. Stakeholders can use that knowledge to double down on successes, correct failures, or pivot toward new opportunities. When reviewed externally, it conveys what resources are available to a business and how they're financed, which helps investors decide whether it's wise to support it financially. External auditors can also use the balance sheet to ensure a company complies with the reporting laws it's subject to. It's important to remember the balance sheet is always based on past data and communicates information as of a specific date. While you can use it to predict performance, past results don't guarantee what will happen in the future. If you want to learn accounting concepts and principles that illuminate financial statements, explore our online course, Financial Accounting, and discover how you can unlock critical insights into business performance and potential.